Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. As always, we need to cover off some important housekeeping details about the session, and then I'll introduce Rob. So first and foremost is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website. If you'd like to read it in full detail there, or certainly feel free to take a screenshot of it now if you like, but that's the main point to take away. Alrighty, I'm pretty sure most out there that are viewing live with us tonight are pretty familiar with the question process, but just in case you aren't, I'll leave that slide up on the screen. And just thought I'd mention that in the weekend market update, Rob mentioned to be aware of a head fake. Well, at the market open at a high of the day and finished lower. Is that the head fake that he might have been referring to? Interested to hear his analysis on that. Of course, excited to interact with you all live. So thank you for joining us for this live session with Rob. And at this moment in time, I'll introduce the man of the hour who we're all here for, and that's Rob Roy.
Hi, everyone. Welcome to TradeFinder Live. Thanks, Zach. And I will talk about what happened in the market here in just a second. Get the camera on so you can see. And if we take a look at the chart, this is what we looked like over the weekend in the weekend update. And taking a look at the highs, we're right up here towards 420, noting that we did have a qualified five-wave pattern to the upside, or we do. That's where the commentary of beware of a head fake came from. We had the news that a deal was reached regarding raising the debt ceiling. Futures were up once they reopened following the holiday. Again, hope everybody enjoyed their holiday weekend. And so the fact that this wave 5 target box here is so close, the reason for the comment on beware of a head fake is we could break to the upside here, but without follow through. So break to the upside, hit the target, and then a reversal. And I know that a lot of you, based on your comments on our recording over the weekend, were thinking that we're going higher now. They've raised the ceiling, etc. But there's also the possibility of sell the news, buy the rumor, sell the news. Could that be going on, especially with the big moves that we had towards the end of the week? Everything AI-based, as you know, went up. So this includes today. And as Zach said, we opened in a high of the day. And we did touch the bottom of that tap box, so it's gone. And we have a wave 5 that's extended 56%. We didn't even really close above 420. So as far as the head fake, I don't know if this would count because we closed back down here towards 420 and back closing spot on 420. So open at the high and close near the low of the day right there at 420. Some could argue, well, we broke out. But it was a bit of a gap up, so we filled the gap, and now we're testing 420. Valid comment. Perhaps that's all this was today, and that we turn and reverse back to the upside tomorrow. I just feel like with this smallish wave 5 pattern, it does set us up for the market to appear like it's breaking to the upside, suck the rest of the retail traders that may not have come in already on the back of the AI stock earnings reports, and then reverse back down, or maybe we take off, who knows? But I just think we're still in cautionary mode. And then you look at the financial networks today, because the market didn't rocket to the upside, they're still waiting on Washington as far as if Congress is going to approve the agreement that was reached to raise the debt ceiling. As you know, I thought they're going to pull this out to the last minute, but again, I just can't imagine there's anyone out there that thinks that the U.S. is going to default. So I do still have that concern in the back of the mind of, is this a buy the rumor, sell the news type of thing? And once everything's all said and done, we reverse back to the downside. We just have to be careful right here. It's not a time, I don't think, to go hard long, at least not the majority of the stocks. And then the few stocks that have been rocketing to the upside with their AI commentary, if you will, are pretty overbought at this point in time. So where would the leadership come? Now, if we do break to the upside, that would likely mean that the leadership is broadening out, which would be very positive for the market. You never want the market moving on just a handful of stocks. So the possibility that we get more breadth to the rally and that spurs us higher, that's what you want to hang your hat on if you're bullish. But I do think that we do need to be careful here until we can clear this 420 level with follow through. And we haven't done that yet. And notice that maybe you would have thought there would have been better volume today than there was. So below average volume and this move back to the 420 level, we're still in that same area of be cautious, and we still are sitting in this massive ascending triangle pattern. That means you could break either direction. You've heard me say this before. If you're joining us for the first time, welcome on the various social media platforms. But most of you have heard me say this numerous times that in the words of Elliott, triangles trump everything. And the fact that we have this huge ascending triangle, even though we are in a qualified 5-wave pattern, still bears the potential of a move to the downside. So just pick and choose your spots if you're wanting to go long until we do get some sort of a significant break above 420 with follow through. Looking at the diamonds were not having a great day earlier in the day when the rest of the market was doing better, and yet still finished just slightly down on the day. But the key here for the DIA is that we finished above 330. As long as we can hold above that 330 level, again, cautiously optimistic, I think is the name of the game for the DIA or the Dow as well. And we put the moving averages on. You can see that we closed basically Friday and today dead on that 10-day moving average right around the 330 level. So it just patience as far as the Dow stocks too is in order. Looking at interest rates, and then we'll go to the Qs. A little bit of a move down in rates today. Is that because, as some have suggested, it's debt ceiling related? The wave 4 is at that 78.6% fib levels, the very last bastion of potential for a fib level. So Elliott would already be thinking it's likely that this wave 5 pattern becomes disqualified. He didn't like it once they moved past 70%, even though he calculated the algorithm based on that last fib level at 78.6. Was money moving into the bond market today? Was money coming out of the equities market and moving into bonds? Is that what pushed prices down? Because remember, prices and yields move in inverse proportion. So if yields went down, prices went up. And so I thought that was interesting. On top of that, the dollar also, not really much of a down day, but more of a plateau, hanging here right around 104. It was enough to put a little bit of a bid, at least in gold today. Silver was kind of flat, but at least the GLD had a little bit of a bid. We'll look at that in the Q&A, I'm sure. So I'll just save that for then. But this fact that the dollar has gone sideways, you could view that one of two ways. We had a really nice 45-degree angle climb. And when that happens, you normally don't get really volatile corrections, but it could roll over here at resistance at the 104 level and move lower. Or if that wave 5 is indeed done, we could see the dollar move up to where it should eventually go up to this previous wave 4 right there just below 106. So I don't know that just a little bit of a pause here in the dollar was anything more than satisfying what was a slightly overbought condition. You can see the 10-day moving average here. We're still a little bit above it. So I don't think it's time to get excited about the metals yet. Just with the fact that we had a little bit of a pause today did give at least a little bit of a bid into the GLD. Now looking at the Qs, Yeah, and this, this has been the heavy lifter, right? This is the one that's been moving to the upside. And what I was saying in the intro, that the stocks that have been working are overbought, and that's really evidenced by the Qs here. 2 vertical, I don't like that. 8 vertical moves. Vertical moves often, high percentage of the time, get retraced. So it wouldn't surprise me at all to see the Qs come back down to 340, retrace this vertical move. Once again, opening on the high, closing near the low, well above the 10-day moving average. And notice that the 10-day moving average also happens to be right around 340. In addition to that, we've got this a little bit of a gap here that could get filled sooner rather than later. So just looking extended from everything that's been working, the Qs, etc. We have 126% wave 5 extension. You can round that to the 123.6% fib extension level there, and we had a 50% wave 4. So we are extended. Anything above 100% is an extended wave 5, and just 2 vertical. So I'm very cautious, at least until this gets rectified on the Qs and all those stocks that have been powering up over the last week or so. We need to get this gap closed with the 10-day moving average, whether we come close this gap below 340 or not. But we are too overbought right now. I don't think you want to be chasing these NASDAQ stocks at this point in time. They were talking about the IWM on the financial networks today. At least they were talking about the small cap stocks, saying they hadn't participated in that big move that you just saw out of the Qs, and they're just sitting here. And we've been in this area here of a trading range. The long-term range, as you know, is 170 to 190. And then lately we've been more in the 170 to 180. So since early March, it's been a very tight range in the IWM, and we're still there, closing spot on the 10-day moving average with the 10, 30, and 50 all almost at the exact same spot there at 175. So where do we go on the IWM? We do have a qualified 5-wave pattern here, but I think to look for this wave 5 target down here, we've got to break 170 first. So same old story here with the IWM. We need to break above 180. If we do, I think we could go to 190 very quickly. We moved from 190 back down to 180 very quickly, so there's not a lot of resistance in the way. So a break above 180 could give a trade there on the IWM, but it has to do it first, and it's tried multiple times here over the past few months and has not been able to break above 180, which makes it that much more important if it is able to do it. It didn't even seem to want, I thought maybe over the weekend that we might be looking to come down and test 170, but we've just held right here in this 175 range, smack in the middle of this tighter range between 170 and 180. So when I see that, I want to look at the ADX, and as you would suspect, with that kind of sideways movement, the ADX is very low down here below 11, almost to 10.5, and also into an area here where the ADX has bottomed in April and May. So if we get down here, could we bounce back to the upside and take off from here? Possibly, but what direction? Because remember, the ADX only measures strength of the move. It does not tell you which way. So a low ADX, if the ADX were to bounce up, that's not telling you that the IWM is going higher. It's telling you whatever move is occurring from a directional standpoint has some strength to it. That's what the ADX tells you. These 2 lines here, the green line and the red line, that tells you who's in control, buyers or sellers. So if one begins to break and the ADX confirms it, it'll tell you there's strength to that move occurring. But right now, they're just kind of snaking here and have been for the better part of 2 months. In other words, crisscrossing back and forth, whipsawing, if you will. So not getting much of an indication of what's going on with the IWM from a standpoint of risk on. Speaking of risk on, we always look at Bitcoin because that's a pretty good indicator of how the market is viewing risk. And just when it looked like we were about to give up the ghost here, been talking about this 27,000 level for how long now? For quite a while. And it looked like maybe we're trying to break below it. But look, this break here that occurred back on the 12th, no follow through. Broke down again here, closed below it on the 18th, no follow through. Did it again here on the 24th. Once again, no follow through. So not able to push lower yet on Bitcoin. So holding the 27,000 level and the 10-day moving average here, threatening to get up there and cross above the 30. That would be a bullish sign. Hasn't done it yet. And so can we hold in here right above this 27,000 level? It's tested it for quite some time now, and perhaps that can hold and give another leg to the upside on Bitcoin. Very well formed wave 5, pretty interesting. The wave 4 here was 61.8, spot on, and then another one of the 123.6% extensions in the wave 5. So once again, that wave 5 was a little extended, so coming back down, especially with this vertical break that I talked about back in April, was retraced and holding here. I still say that you have to just at least keep in mind that none of this vertical move here from 20,000 to 27,000 has really been retraced. I don't think any of this counts through here. So if we can hold and stay above 27,000 here and take off for another leg to the upside, then no harm, no foul. But just keep this in the back of your mind that none of that got retraced yet, and the possibility still exists. So if you're long Bitcoin and we start to move even higher from here, just be cautious of that and protect your gains as they go, and be wary of the potential for a reversal. We look at the actual pattern here, and you look at these moves. Is that a breakout? Because you could easily draw the top trend line here with the lower highs right through here and say, well, that was a breakout that occurred and no follow through, just sideways. But is that a breakout? Is that an early indication that we are getting ready to go higher? Well, it's pretty easy on the chart for Bitcoin right now. You just watch 27,000. And if we can put some distance above it with follow through, likely going higher, we break below it with follow through. You've seen the importance of that. This is why I talk about these rules so often, is they matter. Follow through matters. There's a lot of head fakes. So that was kind of the theme. Beware of a market head fake. So same type of thing looking here. Let's look at some of our foreign markets, the EWA for Australia. And you can see that we didn't hold that 23 level. So we said the next likely level is 22. That's where we are. And so far, at least, we've held that. We did get a little bit oversold here on the low from the 25th and bounce back up a little bit, but pretty precarious right here around 22. You can see why. Look at, it's kind of has to hold here. It tested it back here in December, once again in March, and then here we are trying it again, and there's nothing here. If we can't hold 22 on the EWA, there's a high likelihood that we could be looking at coming down to test these levels around 20 or possibly even below. So nail biting time there on the EWA. We really need to hold this 22 level, and perhaps we do, but we are underneath the 10-day moving average. So one attempt already at 22, that held. Can it continue to do that? So as you can see, now, even though the debt ceiling has been passed, everything is not, guns a-blazing, load the boat, back up the truck, whatever your favorite analogy is that we've been talking about for the past few weeks. We're just not in that kind of a market right now. Perhaps we get there, but we're not there now. And then looking at the EWC for Canada, the fact that we didn't hold 34, and we said, 34 just had some support. It wasn't a whole lot of support. It was kind of more that we traded through that level than it acted as support and resistance. A little bit of a bounce there off of February, but we couldn't get above these highs right back here around 36, which was the wave 5 high at the end of January, early February. So that's been a pretty hard ceiling, bumping our head against that a few times, breaking below 34, trying to break even lower. Look at the moving averages, though. We're a tiny bit oversold, not significantly so, but you have to take a look at the high possibility, I think, right now, if we don't get back above 34 really quickly, that we could fall back down to 32. And once again, you look at what happened when we were here before, and that was a fairly vertical run back to the upside. So there's not a lot of resistance on the way down. So perhaps we do look at coming down towards 32 on the EWC. The only thing that changes that, once again, is a quick move back above 34. That's what needs to happen if we're going to start looking at anything more to the upside on the Canadian market. India, here we go again. Man, you got to respect this. Look like, yeah, we could be falling apart here. We had gotten below 41, no follow through day there. Below it though, just sideways, and the potential of moving down to 40 was there, but able to jump back above. And this is what I'm talking about with the EWC. Can it do what India did? Jump back above that area of what was support and now becomes resistance. India was able to do that. It's still technically in a qualified pattern, but once again, the wave 4 is over 70%, and Elliott would be very suspect of that move and cite that there's a likelihood that that pattern becomes disqualified as well. As long as we're staying above 41, I think it can be long the INDA. It's been a great trade. We got up here, we completed this zigzag pattern right through there. So that was done. And now we're back testing that level around 41 so far. Positive test, little bit of resistance here where we are at 42, which you got to rather quickly. If we can get above 42, look at that. If we can get above 42 on the INDA, we could have something really going here, at least a test of these recent highs up around 44 plus that from September and November, December. But we got to get above there first, and we may. We're a little bit overbought, so the sideways to slightly down day to day, not a surprise because again, we got a little bit overbought with the move here on the 26th. So we'll see what happens if we can break above 42. That could be a place to look internationally. And then the EWG. Germany, we've talked about quite a bit, along with India, has been the international places to be, plus one that I'm going to show you that we hadn't looked at in a while. It's been on the financial networks, a lot of chatter, which is the Japan market. So we'll look at that in a moment. And there you can see the EWG has broken below 29, and we did get follow through there. Little bit of a move back up, but so far just up to the 10-day moving average, tapped the 10-day moving average on the high, closing down lower than that. But there is support not far away. So that's what's interesting about the EWG right now, is that we've given up 29. We're below the 50-day moving average. We've had a negative cross between the 10 and the 30, a lot of negatives there, but yet there's some support here at 28. If we can hold 28, then perhaps we can gather ourselves and try to make another move back to the upside. If we don't, it's the same type of thing here. There's not a lot below. So you can see that some of these levels that we're just above or testing from a support resistance standpoint are really key because there's significant moves, not just small ones, but significant moves below if we break down below some of these support levels. So 28 to 29 is your key here on the EWG. If we can get back above 29 with follow through, we tried here. Back in the 19th of May, it got turned back, broke back below 29. So your support's at 28, resistance at 29. It's kind of a sideways trade until one of those two levels gets broken. Sound like a broken record, speaking of broken, because a lot of them are the same. All right, so I did mention Japan. There had been a lot of chatter on the financial networks about how well Japan had been doing at the start of this year. And you can see, yeah, that was a pretty good run right through there that started back in the middle of March. A bit of a zigzag pattern right here. And 61.8 is the C wave extension. We went past that, didn't quite make it to the full 100%, but we did go past the 61.8. Now we're back testing that now. So can we hold right here around 60 for a potential turn back to the upside? Or is that it? Has that move in the Japan market run its course? Will be interesting to see how that trades over the next few days. We did close below the 10-day moving average, but we're above the 50. There's more support down here around 59 than there is here at the 60 area, even though it looks like it's trying to consolidate here for the better part of the last week. It's tried to. So if we can hold there, great. But it feels like it really wants to come down and test 59, and then we see. That's when we'll know whether this is just, all right, we're consolidating some of these recent gains, go sideways a bit, and then try to take another run. So a break below 59 changes the entire thesis on Japan. But I did want to show you, because if you listen to the financial networks, they made it sound like the Japanese market is off to the moon. And it did complete this zigzag, extended a little bit, and now we're back down towards a 61.8% level. But we hadn't looked at the EWJ in quite some time, and I thought with the fact that it was in the news so much that it bared paying attention to, so giving that a quick look. So if we take a look at our website, and this is a trade that we did for PINS. This is in our time strategy. So this is Pinterest, and it was a calendar spread, as you can see. And I wanted to show you something that occurred here. Even this had a little bit of a drawdown. This is a mark-to-market graph. It shows you where every single one of our positions are every day. This is exactly what it looks like on our website at ewotrader.com on every alert that we send out to our subscribers. So our alert subscribers get all this information. You get an entry alert, and this is what we were looking at. We had the big drop to the downside. Our AI gave it a score that says, hey, we're likely to stay in this trading range for a bit. And that gives us the entry to move in, because you get those big moves and oftentimes they'll go sideways. And then we moved back to the upside, and you can see we had a really nice gain here, over 50% in just 17 days. And here's what the chart was looking like. We were coming back. So we had dropped a little lower and then came back. And so we're sitting right here at our strike price of 22.5, and you have over a 50% gain in a calendar spread in less than 21 days. So that's a really nice return. You want to take advantage of that when you have that opportunity. And as it turns out, and you go back and look at where Pinterest is now. So we take a look at the chart, Pinterest at this point in time. There's where we were when we exited, and then boom, look what's happened. So at this point in time, it looks like a really good exit on that position. When you have one that's just spot on your strike and you've got a nice gain like that in a relatively short period of time, 21 to 28 days-ish is about the average time for time decay to work. You get a boost of an IV drop as well. When you put on a put calendar after a big drop in the stock, they spike the IV. So by putting on a calendar and selling that short-term option, the IV comes back down, you capture that. Clearly, with the stock moving back to the upside, they were sucking all that volatility out. So that helped us as much as some time going by. But when you start running back up to the upside like this, our exit was pretty good. Now we do have a doji there. Maybe we come back down, and you look at this at June expiration and say, yeah, well, if you'd have waited a little bit longer, but you have over 50% in 17 days and you're right smack on your strike, you're going to take that. It's an ideal exit point, even if you come back and Monday morning quarterback and say, well, if we would have waited a little bit longer, it would have done better. You can't second guess in the world of trading. If you're happy with your gains, when you take the position off, be happy with them, move forward, regardless of what happens from there. If you second guess yourself, you'll drive yourself insane. So you make a choice and be happy with it. You were happy with it at the time you made the choice. So you can go back and look and learn and perhaps add that information into the next time you have this scenario. Don't second guess one that you've already done, especially when you had a relatively nice gain. So wanted to share that with you. I thought that was pretty interesting. Now, our case study considerations that we're looking at, and the difference between that, if you're newer watching, is we do look for case studies each and every week here on TradeFinder, and we identify stocks, and then we say, this stock looks like it's going to do X, and then you're on your own to create a position, manage it, etc. The difference between TradeFinder and our alert service at EWOTrader.com is we send you, as you just saw, alerts for entries, any adjustments, and exits. So helping you along the way. So on Eastman, this one was a triangle, and we had talked about how it had gone through and formed a larger triangle. And now it looks like we're trying to break to the downside again. So breaking below 80 today is interesting, but we've got to get through this level. So we need basically to break through 78. If we do, you look and you can clearly see on the chart, same thing I've been highlighting all night. is if it doesn't hold that level of support at 78, there's nothing in the way, and we're probably coming all the way down here towards 70, which would be fantastic for a strangle. So looking good so far, but not enough of a move to where you couldn't just say, hey, this is just all part of that much larger triangle that was formed. That's when it gets frustrating in strangles. But as I've mentioned in the past, when you have a larger triangle form like this, in other words, we had a pretty well formed triangle here, and then look like we were breaking to the downside, and then look like we're breaking to the upside. You don't get two false breakouts. You can get one directional false breakout, but you don't get two. If it looks like there's two, then that means that you're forming a larger triangle, and that's what's occurred here. So I don't think we can even call that sneaking out of the lower trend line yet. So not ready to say, hey, we're looking for this one to break to the downside. We looked at RIG back here on the 2nd of May. And remember, this is a longer term one. We did send this out as an alert to our alert subscribers in our speculative portfolio because this was something that we liked for other than the guidelines that we list as our guidelines for entering and exiting alerts on our specific portfolios. And we've had a little bit of a move to the upside, given some of that back, but held 6 today and a little bit of a gain here so far. But as I said, this is a longer term one. You could have taken some gains right back here if you wanted to, but we do want to see if this is going to come up here and test these highs, which we think over time has a high likelihood of occurring. As long as we can stay around this 6 level, we'll continue to give it time. And as I said, plenty of time on this one going all the way out to November on the options. And then we had our 2 home builders. And we talked about these last week that you could have gone ahead and closed these out. So the first one is on MHO. I said I would keep these in case some people were still following them. Well, there was the big move to the upside that you could have taken advantage of. If you're still watching it, I think you're probably still okay for now. But when I show you Lennar, that might change your mind. So this could have been closed for a gain. And with me and the home builders, just follow the charts because from a fundamental standpoint, I've been completely wrong on these. So follow along with the charts, coming back, testing 70, breaking back to the upside. So if you didn't take your gains back here, perhaps you're going to get another opportunity. But Lennar is a different story. So that's what it looked like, exactly like MHO, but this one has moved lower. So this looks like more of a company specific issue rather than the home builders as a group. Looking at the moving averages, see we are below the 10-day moving average. We're just now getting a negative cross on the 1030. If you have a big stomach for risk, then you could hang in there as long as the stock stays above 105. You could say, okay, I liked 110 better last week, but there is some support at 105. So if you're long this and you're still long and you're a long-term believer in the story, you could give it a little bit more room. But I think this is giving you warning signals that, hey, you probably want to look at exiting this one if you haven't already. So back here, we had a chance for small gain, not much. And then down here, so not looking too great on those 2. MHO looking a little better than Lennar, which is interesting, but below the 50-day moving average is concerning. The negative 1030 cross is concerning, but there's a little bit of support here at 105. A slight possibility that we come down, hold that and bounce, and you can maybe add to it or whatever. But this one looks like it's kind of telling you probably should close this position out. A big move back above 110 in the next day or two might change that thesis for me, but for now, this one looks pretty iffy at best. So I think you want to be really careful there. Looking at DOW, which we looked at here back on the 16th of May, and this is a descending triangle pattern here for another strangle, and we did send this out as an alert to our alert subscribers, and one of our subscribers wrote in, and that's another thing that you get as an alert subscriber at EWOTrader.com is not only access to the alerts, all the education on the website, but you also can send in messages to support for administrative issues, or you can follow forward through messages to me as well. And one of our subscribers asked a question, really good question, of do we want to consider taking the calls off due to the fact that it looks like the stock is breaking to the downside. Pretty close to pulling the trigger on doing that today. As you can see, we broke below 50, which was what I wanted to look at, but this doji. So that's a little bit of a concern there. If we get any follow through at all on this break below 50, then we likely will take the calls off and just let the puts run. But main rule here is that you don't want to take one leg off until it means the entire position is at least break even. So you, in this case, take the puts off and you have no risk in the trade. Then you can, or excuse me, the puts have put you at break even. You take the calls off and let the puts run here, then you'd be okay from that standpoint. But just, looked at it very closely today. I like the formation of the doji. So I think we want to give this a little bit more time. Then we can take off the calls for whatever premiums left and let the puts run because there's a lot of support all the way down here in this area around 45, and that would be a really nice result on the strangle, whether or not we close the calls out or not. So looking at the moving averages, a little bit oversold today with the doji. Could it mount a little bit of a bounce? Just don't think we warrant taking the calls off just yet. Again, we may do that tomorrow, depending on what the stock does, what this doji means. Does it mean we're going to bounce from here? Are we going to continue lower? Big move, 5 more points to the downside available here on DOW if we continue lower. So that could turn out really well. And then last week we looked at this one, EMR, Emerson Electric, very large descending triangle here. That was a nice one. When we were looking, we found a lot of triangles, but some of them smaller mouths, which means they didn't really have much room to break to the upside or downside to break out of the triangle. This gives you a little bit more room, and you look at that, and another one that looks to be breaking lower. So you can see this looks like this could work out extremely well. A little bit more to the downside, and that would be a great position. So nice potential breakout of the one that we just looked at last week. So that's looking good. Again, looking at the moving averages, a little oversold, not quite as much as we were on Dow. And we're in an area here where it just doesn't look like there's much to stop it from coming down here towards 73. And again, that would be a great result out of this one as well. So pretty nice breakout here on EMR. Again, just one of the alerts that we looked at last week. So that's about it for the case study considerations that would still be considered open, possibly again with whatever you did on the home builders, etc. But perhaps a little bit more on the strangle breakouts, and then they could turn out extremely well. Well, let's see if we can find a case study consideration for tonight. And bringing up the searches, if you're not familiar with this software, it's from the Hub organization, hubb.com, and go find out more about it there. To me, it's the best Elliott Wave software that exists. Tried all the ones that I know to exist. And if you are an alert subscriber with Elliott Wave options, EWOTrader.com, and you have the software, you get these searches. These ones that have EWO on them here are my searches. So those are my parameters that I've tested over time and I'm comfortable with. And so you can look at what I'm looking at each and every day on the searches, which I think is pretty cool. We do have one result on the impulse. Let's see what it is. I have not looked at this ahead of time. I did last week because there was so many on the consolidating stocks, and there still is. If you take a look at this, the negative here is going to be the fact that we're a little bit overbought. I like the volume here. It's not out of control with this move to the upside. The DMI is still very strong. The ADX is getting up there, but it hasn't reached 40 yet, so still okay here. Big separation between the two directional indicators. Bulls, buyers firmly in control. The ADX telling you there's strength to the move. Turn the Elliott wave pattern on. There's no 5-wave pattern. So then you want to look at zigzags. because that means that we're in corrective patterns, flats, zigzags, and triangles. So which one is it in? Clearly this one is in a zigzag. You can see that here. And you look, and perfect 50% correction. It's already past the 100% extension. That's what it's supposed to do. So we've gone vertically up here. A big move today, piggybacking on everything else tech related. But here we are with breaking above also resistance that coincided exactly where that 100% extension was. But I don't like this vertical move. There's too much separation for me from where we are now and the 10-day moving average. Wouldn't be surprised to see it come back and test 90. That may be all it does. Perhaps we're off to the races here, especially with a very constructive DMI like that. So usually then I'll look at the CCI because it's a shorter term indicator. It's more responsive day to day than the DMI, tad bit more lagging. And you can see that on the CCI, we're kind of up in this area where we've been turned down a few times. On the CCI, perhaps a tiny bit more, but not a whole lot more. And so every time we've done that, we've had moves to the downside. So this is danger, danger, Will Robinson, I think, on this one. So, perhaps there's a little bit more. Perhaps we go up to this 161.8% extension. That possibility exists based on the DMI, but I don't like the vertical move and I don't like the separation between the 10-day moving average. So, keep an eye on this one, put it on the watch list, see if it comes back and test 90. Maybe if we come back down and test 90 and consolidate a bit and then take off, then you can look for a trade from the 100 to 161.8% extension. But I think you're chasing it if you go now. It's just too vertical. So I would wait and see. So it looks great right now, but it's overbought short term. The question is only, is that it? Or do we consolidate a little bit of this short-term overbought scenario and then run higher? We'll give it a couple of days. Again, a very good watch list stock here, and we'll see from there. So that brings us back over. The VIX did close at 17, so we're low again. That brings us back over to our consolidating stocks, 116, way down from that 140 plus that we've had for a couple weeks, but still a lot of stocks. So I'll just look through here and see if we can, let's see what Home Depot looks like. It's just too sideways. One of the things that we like for consolidating stocks is a very low ADX. You can get a low ADX when the stock consolidates sideways. It doesn't have to go into a triangle. So that's why you want to look at the pattern and see if it isn't an ascending, symmetrical, or descending triangle. In this case, it's not. So let's go back. See if we can find something else. Netties. Some of these are familiar from the past, but that's another one that was very sideways and then has had some volatility lately, but not really a triangle. If there was a triangle, you would almost look at this one as more of an expanding triangle rather than a contracting one. So you just flip it over the other way. The point's to the left instead of the right. That's what that looks like to me, especially with the fact that even with this volatility, the ADX has continued lower. But we could stay in this range here. So I think we could do better than that, find something else that perhaps looks a little bit more, a little bit better. We looked at, I think, then we look at paychecks. Did we look at that one last week? And yeah, that's another sideways one. See if we can find a triangle here. Lowe's. Home Depot's consolidating, perhaps Lowe's is too. It is a tiny bit more of a triangle here on Lowe's. It might be a little expensive at $205. Look how low that ADX is. That's what's attractive to me. The ADX is almost down to 8. So it does look like perhaps there's some sort of a breakout coming here. We do have a little better than a 20-point mouth here. You probably could call, even though this move here in early April didn't go quite that high, but we have resistance at 215 and we have support at 190. So depending on your risk tolerance and how much you're willing to put at risk, that actually looks pretty good. So a break from here to 215 or a break down to 190 could generate a gain, especially with the ADX that low. So let's go ahead and look at that. So for tonight, tonight, and I know if you're wanting something directional, you're probably disappointed in another strangle, but you take what the market's giving you, and right now it's saying that we haven't broken either direction yet. So LOW in a strangle will be our case study for this week, and that marks 3 strangles in a row. Again, I know that's not exciting to you, but at this point in time, it's what's prudent to do until the market makes a break from this very large ascending triangle that we have. We're going to get this is where I encourage patience. That triangle is so large, and you can see how long it took to form. The likelihood is we're going to get some sort of a significant breakout, and it'll probably last a while. So you'll have plenty of time for directional trades, is my point. So don't chase it yet. Let it make its break. Let it make a definitive break, and then let's go along for the ride and put on the best looking directional charts that we find at that point, depending on which direction it breaks. So I just think that's the smart thing to do at this point in time, even though it may not be the sexiest thing to do. So with that, Zach, I'll turn it over to you, and let's do a little Q&A.
Sounds great. Thanks, Rob. That was a very enjoyable presentation as always. So let's get to some Q&A. We'll get through as many questions as we can with the time remaining. I thought we might start out with some stocks that are definitely in the news right now, aside from the everlasting bullish run for NVIDIA. We'll start out with TGT, Target for Alan.
Target, as we joked about last week, Target, and last time we looked at it, it was going vertically down. It looked a little bit oversold. It looks even more oversold. You see this this move lower here. You know, it's evidence that the consumer, but you know, you had some interesting stocks that have done well. Abercrombie and Fitch, some of the old guard stocks, if you will, retailers had surprisingly good earnings. So the consumer hasn't stopped spending, but they seem to be very, you ready for this, targeted in their spending. And apparently the brick house Target is not one of the places they are targeting to spend their money. All right, that's enough of that. But this is really oversold at this point in time. And I didn't listen into the earnings report here and didn't have anything on Target. So you just look at this, and it broke below 155. And so that gave you a clear sign that you're probably coming down to 142 or 3, maybe even testing as low at 140. That's where I thought we would at least try to hold, but it didn't. I mean, we stopped there one day, but we're pretty oversold here from the 10-day moving average. When things go vertically up or down, you can see the evidence here. See what happens? Vertical move up, boom, back down. Vertical move up, boom, back down. Same thing here, vertically up, back down. Well, it works the same way in the opposite direction. So we've had a vertical move lower. So likely that we get some sort of a bounce, but at this point in time, with today's move, that bounce may only be back to test 140 and allow the 10-day moving average to catch up if there's more downside to come. So you could have a short-term trade here, perhaps back up towards 140, but I don't know that it goes much further than that, because there's something, I'd have to go back and read what was said, et cetera, on what's going on here with Target. They've been a pretty good performer for a long time, but something's up right now with them, because that's ugly. And if we take a look at volume here, notice that the volume is not out of control. You're not getting these massive spikes like you had back here in November. That's what could spell a bottom. We are adding to volume on the way down. Likely means there's some institutions that are bailing. So whatever they said was not very bullish for the longer term. So again, I think the best you could hope for the upside is some sort of a bounce back to 140. If you're looking at this as a downside trade, I think you have some potential there, because you can see 140 was it. It needed to hold there, which is, where I thought it might try to hold, but the fact that it went right through that so easily, there could be more downside to come. And just, do we bounce back up and test 140? The ideal scenario for a short position would be to get a bounce back to 140 and then watch it start to turn and come back lower. That would be a great entry for a short. But to chase it now to the downside, again, you're chasing a stock that's oversold. And there's some, what they'll do to you is, if you tried to buy puts on it right now, they'd be so expensive from the volatility. And if there was a little bit of a short-term bounce, they'd immediately suck all that volatility back out. And you'd have a bigger loss than you normally would have on just some sort of a small bounce against you. So that's why I'm saying that you don't want to chase this now. It's oversold. Let's see what happens with this 140 level if it tries to come back and test it. The further oversold it gets, the more likelihood there is of a bounce higher. So if it were to close or go lower again tomorrow, just the same scenario, just a higher probability of that bounce back up to test 140. But wow, that's pretty ugly.
Yeah, and your technical analysis there was on target.
Almost a Katie bar the door here.
Almost to say it.
Almost.
So Target actually took a $9 billion hit in one day. So that's
that's pretty ugly. Yeah. So it makes me curious to go back and what did they say that that was so bad, and why are shoppers not going there anymore?
It's because of the recent marketing and changes they've made in clothing in regards to LGBTQ and whatnot. So we'll leave it at that. I thought you might be able to infer what the next stock would be, as it's in the same situation or incident, we'll say, and that is Bud.
Oh my. It just it's questionable marketing decisions for sure. Why I have no idea. But if Target is in that boat, then you can understand. There's a lot of backlash against Bud for that marketing they did around the Super Bowl, and agree with it or not, there's been a pretty good outcry against it. It just feels like the marketing wasn't targeted at their primary group. I know companies like to be all things to all people, and you can kind of see where that argument plays in. But when you have such a sensitive issue, it's interesting to have been in the boardroom and hear how those conversations went. So I wouldn't touch this to the upside for anything. It's a little bit oversold. You could argue that it's a little oversold today, but it might not be that bad. It's in no man's land here. I don't think anything stops this until it comes all the way back down here towards 45. I think that's where we're headed on Bud. The only question is, do we get any sort of a bounce first? Could you get any sort of an entry first? And I think it would be it's not a big move. It's only going to be $1 or $2 move if you were to get that opportunity. Perhaps Friday was what gave that opportunity. And you can see what I mean is that it bounced back just a little bit, not much. And then another leg lower. I do think we see Budweiser at 45 at some point. Anheuser-Busch at 45 at some point in the not too distant future. Just, do we get a little bit of a bounce first? I'm not normally a fan of putting on spreads on the put side because the volatility helps you so much when you get the direction right on a put, and they tend to go faster. So with calls, spreads make a little more sense, because even if you get the direction right, a lot of times they take longer. So protecting that time decay by putting on a spread makes sense. Normally I don't agree with that to the downside, because I think you can shoot yourself in the foot a little bit. But with this one, putting on a spread could limit a pretty significant move lower. But you've got a lot of volatility in the puts too. So this is a tough one as far as what strategy you'd put on. I'd have to go do an options analysis and see what makes more sense. If you're going to do a spread, it'd need to be a wide one. so that you can have room here. But again, it just, is there any sort of a bounce? Because aside from all the negative publicity and everything that's going on, that was a move from 45 to 60 nonstop. So there's nonstop back down. Wow, that's a couple ugly charts in a row.
Yeah, it is a fact. Yeah, and it'll be interesting to see the future of where those charts go.
Yep.
Next up, we'll go to David. Happy Tuesday, Rob. Any chance we saw a blow off top, and can you comment on the day AVGO had today? Thank you.
Yeah, that actually came out in the market update with the comments. People talking about the old Broadcom, and look at that on Friday, and it just insane move today, way overbought, and you can see it opened here and then just got out of control. That's way too vertical. Now on the move to the close, on the low of the day, it rectified a lot of that overbought scenario, but not all of it. So we have this gap here, which is concerning. It wouldn't surprise me to see this come back down, at least if the market doesn't take off to the upside and close this gap. I just think these stocks need a little bit of a rest. This is nutso time. This reminds me of 1999, and we've been doing a lot of commentary along those lines with, when the internet was coming out, stocks were getting ridiculous valuations because nobody really knew what the internet was going to bring. And I don't know if anybody saw, maybe some did, how big the internet has become and an integral part of our lives, etc. Same thing is true with AI right now, with all these tech companies and everything. Anybody that says AI and their stock takes off, just how it was back in the .com era. So this is kind of eerily reminiscent to me that, some of these are moving to the upside. So the question, was that a blow off top? I think so, at least short term. I think this kind of stuff is probably done as far as these vertical moves. The only question is, how much further down does it come, and can it catch itself in a decent market and start to climb back to the upside? But I'd be really surprised if we don't see it come down at least to 740, somewhere in this area here, 730 or so, and fill that gap. And then we take a look at it then and see what happens. But no way you can chase it to the upside now. And because it sold off so much today, I don't even know that would risk that as a short-term short. Maybe. See, we closed at 800 and got, maybe. But yeah, the big reversal occurred today. If you were watching that earlier in the day, then you could have just said, there's no way this continues, and had a good short then. But yeah, that is a pretty amazing chart right there.
Yes, indeed. And it's about the exact opposite from the last couple.
Yeah, I
charts.
was just about to say that. Yeah, good comment. Yeah, I mean, we're seeing vertical moves in both directions, and so pretty interesting market right now.
See, we have a hand up from Daniel. We unfortunately don't have time for voice questions in this session. However, we do have a 45-minute Q&A portion on the insiders meeting. So obviously a very high likelihood of getting your question addressed there. Rob and Jeff usually do a great job at getting through every question. So please feel encouraged to attend that meeting to ensure that you can ask your voice question. And we'd love to hear your voice and put all of your voices to names. So that goes for everyone out there. Please feel encouraged to attend the insiders meeting. Okay, a couple symbols for you. First one is ADBE.
AD what?
ADBE.
Oh, Adobe. Okay. So almost thought you said ADHD. And I was going to say, yeah, this is definitely a market that has no patience right now, so or focus. And here's another one. So y'all are finding them all. I mean, because this has been across the board, right? We had Adobe on back in April, and certainly would have been nice to have stayed this long, but you take positions off when you're comfortable and be happy with that. But here's another one that's vertically up, another one that reversed intraday. Close on a low. It's like people were just itching to buy this morning coming off a holiday, I guess, when the market wasn't open. But these stocks are just too vertical. If you could get an entry around 380 on Adobe, so we came back down here, it's where tons of support is. The wave 4 is forecast there. If the wave 4 were to start, we're way overbought. It's where the 10-day moving average is. A lot of things converging, but no way to chase that to the upside. This one, perhaps there's a little bit of downside room. So, I think some of these stocks that you're spotting here with these huge vertical moves could be very quick short-term shorts. And when I say that, I'm talking about a day or two trade. These are very short-term trades. And it's not like, okay, we're going to buy puts for 2 months on these. These are very quick short-term trades. When you see these vertical moves and they get overbought like that, especially these intraday reversals that we saw today, where we opened near the highs or opened and ran high and closed near the lows, closed the gap some, but I think there's more to go here. But very quick, it'd be very interesting to look at some of these next week again. So we'll keep a note of these stocks that we're looking at and see what they look like next week. What's the next symbol?
All righty. The next symbol is QCOM, and I see we are 2 minutes after the hour. So you let me know if this is the last question for the evening or how many more you'd like to take.
We'll take 2 more symbols. I mean, this is the stuff, that occurred back in 1999. You saw these massive moves. Just everybody's trying to get in front of the big moves now. And so it does look like this is a good wave 5. In other words, that's the end of it. 61.8% wave 4. Here's one that I think probably does have more upside. I'm a little more familiar with Qualcomm. It's a stock I used to trade a lot, but it's a little overbought right now. I just don't like this gap. But I don't think it falls back below 110. If you were able to get in at 110, I think that'd be a really good entry. But this one looks like it does want to work its way back to the previous 4. That's what should happen at this point in time. Not quite as vertical as the other ones. So some sort of even a slight pullback here, I think could give you a really good entry for some follow through here back up. So this one I like a little bit more as far as potential move to the upside than some of the other ones that are just way too vertical, that need more significant pullbacks first. So pretty interesting chart there, especially with the Elliott wave pattern.
Thanks, Rob. Next symbol for you is going to be CRM.
We haven't looked at Salesforce in a while, so that's another blast from the past here. Pretty nice move higher here as well. A little more normal, still a little bit overbought, but nothing like all the vertical stuff that we've been looking at. It has been crazy times, hasn't it? So 140% extension is way extended on, call it roughly a 38.2% correction. So, there could be, let's see what the DMI looks like on this. Yeah, Salesforce, it's a tiny bit overbought. The doji worries me, so I'd want to see what happens tomorrow. But it's not much overbought. Maybe we get a little bit of a pullback tomorrow. We'll see. Again, the doji, so I'd want to see how it opens tomorrow. But the DMI is setting up to where this one has more to run. So perhaps we do go up to that next fib extension at 161.8. That one looks pretty interesting too. Again, I just want to see what the doji means and what happens tomorrow first. But DMI is supportive there of potential strength.
All righty. Thanks, Rob. And the last symbol for this evening is going to be PDD.
And we'll take a look here. More normal chart for a change. And a little bit of a bounce here, but it's still in a qualified 5-way to the downside pattern. It tried to get above the 50-day moving average Friday, gave it back today, but it also gapped up Friday. Was that earnings? Is that what the gap was on? Was that a earnings gap up? We have the data for that, but to see if gosh, can it get back above 70? That's going to be the key. This one's really interesting because there's good support here at 60, even though it is in a 5-wave to the downside pattern. So I would want to, I wouldn't go short yet until it broke 60. You got plenty of room if it breaks 60 to that wave 5 target, but it's got more room that it could bounce higher here in the wave 4. And it's right at an area of resistance. 70 is key. You can see it goes all the way back here to November. So there's resistance going in April, May. So areas here of resistance, getting above the 50-day moving average Friday and giving it right back today. It could have just been a little bit of a tiny overbought condition, but to go long, this was pretty interesting. So 60 and 70 are your guides. If it can get above 70 with follow through, then we could see it come all the way up here towards 90. At least take a look at filling this gap here that hasn't been filled yet. But it's got to get back above 70 with follow through, and it wasn't able to follow through that big move on Friday. But as far as the downside, I would want to see it break 60 first. So to me, this is a watch and see between 60 and 70, and those would be your two keys on whether going long or short. But a couple really interesting ones there at the end and wild ones before that. But that's what the market's been. The market has been really wild here lately. So hope everybody again enjoyed your holiday weekend. Thanks for spending some of your Tuesday evening with us. We do appreciate your time and value it. We're very sincere on that. Time's the most valuable asset we all have. I hope you enjoy the rest of your week. Look forward to